SCHD is the gold standard of dividend ETFs. It's reliable, consistent, and filled with top dividend-paying US companies. But here's what most people don't realize. SCHD alone might actually slow you down. Not because it's bad, far from it, but because it's incomplete. While it offers stability and income, it leaves out two major forces that drive long-term wealth: global growth and tech innovation. Without those, your portfolio might be solid, but not strong enough to reach your goals faster. The solution isn't abandoning SCHD, it's adding what it's missing. In this video, I'm going to show you and Josh the core risk involved, how to fix those blind spots, and at the end of this video, you'll see exactly how to combine SCHD with two powerful ETFs that cover what it's missing. I'll walk you through three easy-to-follow strategies. One if you're in your 20s or 30s, one for your 40s, and one if you're 50 or older. So no matter where you are in life, you'll know exactly how to build a $1 million portfolio. But first, why SCHD isn't a complete plan? So here's the thing. SCHD is a great ETF, like really solid. It's packed with big, reliable US companies with strong fundamentals and a solid track record of paying dividends. Investors love it because it's predictable, consistent, and has weathered market storms better than most. That's exactly why so many investors love it. But here's the problem. If your entire retirement plan depends on SCHD alone, you might be setting yourself up for a slower journey than you think. Let me show you what I mean through two different investors, Peter and Josh. Peter is our play-it-safe guy, conservative, focused, and disciplined. He reminds me a lot of the folks who love SCHD. Then there's Josh, more open to growth, willing to diversify, but still smart about risk. We're going to follow both of them so that you can see how these two mindsets play out over time and why relying on just one strategy could cost you hundreds of thousands of dollars. Let's start with Peter. Back in the late 1990s, while everyone else was jumping into wild tech stocks, Peter stuck to what he knew: reliable dividend-paying US companies, the kind you'd find in SCHD today. So when the dot-com bubble burst in 2000, Peter barely flinched. While portfolios around him were collapsing, his held steady. On the surface, it looked like he'd won. Now meet Josh. Josh also saw the crash, but instead of clinging to just one style of investing, he stayed open. He learned from the recovery. He saw that while Peter's portfolio was steady, it wasn't growing. Josh started shifting some of his money toward innovation, toward companies like Apple, Microsoft, Nvidia, and also began diversifying globally. He didn't abandon safety, but he didn't let it trap him either. And that's where the paths really split, because markets don't stand still. Over the next decade, the tech industry reshaped the global economy. Companies like Apple, Microsoft, Nvidia, and others led a historic wave of innovation and wealth creation. The NASDAQ 100, shown in the chart, surged from its post-crash lows and exploded into a multi-decade bull run. Meanwhile, Peter stayed the course with his dividend strategy. His investments stayed stable, his income stayed steady, but his portfolio didn't keep up. He missed one of the greatest wealth-building windows of his generation, not because he made a mistake, but because he never adjusted. That's the real risk. It's not just about losing money, it's about missing opportunities. Like that, many investors today are making the same mistake with SCHD. It feels safe, it pays, and it looks great on paper. But SCHD by design is focused exclusively on US companies. Not just that, but mostly in defensive sectors like energy, consumer staples, and healthcare. Nearly half of its holdings are concentrated in just 10 names. It's a steady vehicle, but not built for acceleration. Over the past decade, SCHD has delivered a total return of 114%. Not bad at all for a dividend-focused ETF. But when you line it up next to growth-heavy giants like QQQ, the difference is staggering. QQQ, which tracks the NASDAQ 100, home to companies like Apple, Nvidia, and Microsoft, returned over 402% in the same period. That's nearly 4 times more growth. SCHD is excellent at preserving wealth and generating income, but that's not the same thing as building wealth quickly. If you're in your 20s, 30s, or even 40s and aiming to retire faster, reach financial independence, or compound your money aggressively, then SCHD can't be your only strategy. It needs reinforcements. That's exactly what I'll show you next, the 3 critical blind spots baked into SCHD's design and how they might be costing you more than you realize. And at the end of this video, I will show you how to combine SCHD with 2 powerful ETFs that fix the 3 blind spots. I'll walk you through 3 easy-to-follow strategies, one if you're in your 20s or 30s, one for your 40s, and one if you're 50 or older. So no matter where you are in life, you'll know exactly how to build a $1 million portfolio. But first, the 3 critical blind spots of SCHD. The first major blind spot is concentration. On the surface, SCHD seems nicely diversified. It holds around 100 stocks, and that feels broad. But when you zoom in, the balance isn't what it seems. Almost 40% of the entire fund is concentrated in just 2 sectors, energy and consumer defensive. That's a massive weight on a narrow slice of the economy. If those sectors underperform, whether due to shifts in policy, inflation, or changes in consumer habits, your whole portfolio gets dragged down. Even more, nearly half of SCHD's holdings are tied up in just 10 companies, so even though it feels broad, it's actually kinda top-heavy. That's not the kind of protection most investors assume they're getting. The second risk is opportunity cost. Because SCHD is built for safety, it leans hard into companies that are stable and mature. That's great for getting consistent dividends, but here's the problem. It often skips the biggest drivers of long-term market returns. High-growth sectors like technology, biotech, and innovation. Companies like Nvidia, Tesla, or even Apple in its earlier years, those don't really show up in SCHD. It skips most of the action in tech, biotech, AI, all the sectors that have driven massive returns over the past decade. So by focusing on safety, you may be sacrificing the very gains that made early retirement possible. The third one is geographic exposure, or rather the lack of it. SCHD is 100% US-based, no international stocks, no emerging markets. And sure, the US market is strong, but it's not always the MVP. There have been whole decades where countries like China, India, or Brazil crushed US performance. If something drags the US down, like inflation, debt, or economic slowdown, SCHD has no lifeboat. It's all in on one country, which isn't exactly what most people think of when they hear the word diversified. So if your goal is faster wealth building, you need to plug these 3 gaps and understand, starting with diversification. Now, I know that word gets thrown around a lot, but here's the thing. True diversification isn't just about owning more stocks. It's about owning the right mix of stocks across different industries, different countries, even different economic cycles. Let's look at what history teaches us, especially the times when the US market wasn't the hero everyone assumed it would be. Most investors obsess over the S&P 500, but that index hasn't always been the world's best performer. In fact, there was an entire decade where sticking solely to US stocks turned into a painful waiting game. Let's rewind to the early 2000s, often called the lost decade for American investors. As shown in the chart, from 2000 to 2010, the S&P 500 essentially went nowhere. After the dot-com crash and the 2008 financial crisis, the index was barely above water by the end of the decade. You could have stayed invested in US stocks the whole time and walked away with almost no gains. Inflation continued to rise, but your portfolio didn't, meaning your purchasing power was shrinking even if your balance didn't. Now let's take a look at what was happening globally. This chart, which tracks the MSCI Emerging Markets Index relative to the MSCI World Index, tells a very different story. From the early 2000s to around 2008, emerging markets were outperforming dramatically. China, India, Brazil, and other developing economies surged ahead. Their markets were thriving, and the reason is simple. Economic cycles across the globe don't align perfectly. When the US stumbles, other countries can sprint. Investors who diversified globally during that time avoided a slow decade, and they positioned themselves to grow. While US-focused portfolios barely moved, globally diversified ones captured the momentum in faster-growing markets and came out well ahead. Fast forward to today, and yeah, that same warning still holds. If your entire plan rides on SCHD, then you're basically betting everything on just one player, the US market. And don't get me wrong, it's a strong player, but what happens if the next decade looks like the early 2000s all over again? Maybe inflation sticks around, maybe innovation slows, or maybe the weight of US debt finally starts to drag. But diversification isn't just about protecting the downside, it's also about catching the upside. The next Apple or Nvidia might not come out of Silicon Valley, it might come out of Taiwan, South Korea, or Switzerland, and if you're not globally invested, you're gonna miss it. That's why I love VT, and it fixes that problem. It's one simple ETF, but it opens the door to the entire global stock market, not just Wall Street. VT stands for Vanguard Total World Stock Index Fund, and the name says it all. This single ETF gives you a piece of over 10,000 companies, not just from the US, but from all over the world. Big names, small names, developed economies, fast-growing emerging markets. And that's its strength. By spreading across so many geographies and sectors, it minimizes the risk of overexposure to any one economy or industry. In the past year alone, VT has grown 15.81%. Over 5 years, it's delivered 67.38%. And over the last decade, an impressive 114.66%. But it's not just about the returns. VT is also incredibly cost-efficient, with an expense ratio of just 0.06%. That means you keep more of what you earn. Less gets lost to fees. Even with over $63.3 billion in assets under management, it stays remarkably steady. Its tracking error is super low, which basically means VT closely follows its index without going off course. That kind of reliability is a big deal if you're aiming for smooth, long-term growth without the drama. What truly sets VT apart is its holdings. Unlike sector-concentrated ETFs like SCHD, VT's top 10 holdings only make up 19.93% of total assets. These include major global players like Nvidia, Microsoft, Apple, Amazon, Meta, Alphabet, Tesla, Broadcom, and Taiwan Semiconductor. These are popular names, companies leading in their fields. They power much of the digital and industrial infrastructure we rely on today. The broader sector allocation tells an even richer story: 25.59% in tech, 17.31% in financials, 11.37% in industrials, and 8.91% in healthcare. This spread gives you exposure to both high-growth areas and more stable income-generating sectors. It's a thoughtfully balanced approach that allows VT to perform well in various economic climates. For investors seeking dependable, broad-based global exposure without needing to constantly rebalance or research international stocks, VT is a practical and powerful choice. It doesn't try to outperform the world, it simply owns it. And in the long run, that can be enough to win. So now you've got global diversification covered with VT, and you've got a safe income-generating core with SCHD. That's a strong foundation. But if your goal is to hit that $1 million retirement mark faster, really accelerate your growth, there's still one more piece you need. You can't afford to miss out on growth stocks, and that's exactly where QQQ comes in. If there's one ETF built for chasing innovation and long-term growth, it's Invesco's QQQ. It tracks the NASDAQ 100, a lineup of the most disruptive, world-shaping companies out there. From artificial intelligence and semiconductors to electric vehicles, e-commerce, and cloud tech, QQQ gives you a front-row seat to the digital transformation that's already reshaping the global economy. Let's look at the numbers. In just the past 12 months, QQQ has gained 22.47%. Over 5 years, it's up 121.23%. And over the last decade, a massive 414.73% return. Now, to be clear, QQQ isn't designed for stability or high income. It's more volatile than SCHD or VT, and it offers a lower dividend, currently around $2.82 per share. But that's not why you own it. You own QQQ for growth, for the chance to capture the next wave of major tech breakthroughs before they go mainstream. And even with all that upside, QQQ is still cost-effective. Its expense ratio is just 0.2%, which is reasonable considering the caliber of companies it holds. It's also extremely liquid, with over 31 million shares traded daily, so it's easy to move in or out when needed with minimal friction. So where does all that growth come from? When you look into the holdings, it's pretty clear. Over half of QQQ, 51.03% to be exact, is concentrated in just 10 companies. And they're not just any companies. Right at the top, Nvidia, Microsoft, Apple, Amazon, and Meta. These firms are market leaders, category creators, and industry disruptors, setting the pace for global tech advancement. In terms of sectors, QQQ leans heavily toward growth. Technology makes up 53.9% of the fund, with another 15.7% in communication services and 13.34% in consumer cyclical. That means it's less about slow and steady income and more about massive capital appreciation, something SCHD lacks. It shouldn't be the whole vehicle, but even a 30 to 40% allocation for a young investor could dramatically amplify long-term results, especially when paired with steadier ETFs like SCHD or globally balanced ones like VT. Now let's break down 3 ETF-based strategies using SCHD, VT, and QQQ, each tailored to different investor profiles. Depending on where you are in life, Whether you're just getting started, in your 40s, or nearing retirement, your investment strategy should evolve. There's no one-size-fits-all. It's all about adjusting your mix as your goals and risk tolerance change. Most people go through three main stages. In your 20s and 30s, it's about growth. In your 40s, you want more balance, growth with some stability. And in your 50s and beyond, the focus shifts to preserving your wealth and generating income. So here's what we'll do. I'll walk you through three different portfolio strategies using the same three ETFs, SCHD, VT, and QQQ, tailored to each stage of life, and retire with $1 million portfolio. You'll meet Josh, the aggressive growth investor in his 20s, then John, who's in his 40s and looking for balance, and finally Jacek, who's focused on income and preservation as retirement gets closer. Let's start with Josh. Josh is in his 20s, maybe early 30s. Like a lot of people his age, he's probably not sitting on a big pile of savings. Between student loans and starting out in his career, big investments aren't realistic right now. That's totally normal. That's why this strategy keeps it simple. $10 a day. It's affordable. Josh also has something most investors wish they had more of: time. That gives him room to take more risk and lean into growth. So his portfolio is built with 30% in SCHD for steady income, 30% in VT for global exposure, and 40% in QQQ to capture innovation and long-term upside. This portfolio strategy offers a dividend yield of 1.84%, a 10-year dividend growth rate of 8.49%, and an expected annual share price growth of 11.82%. Now, let's see what that looks like with a simple daily contribution of $10. The red line tracks Josh's dividend income, starting at $0 and growing to about $800 a year by year 10. By year 20, it reaches $2,600, and by year 30, it's bringing in $6,000 annually. At the same time, the green line shows how his total portfolio value grows. It begins at just $3,650 in year 1, climbs to $68,000 by year 10, hits $298,000 by year 20, and passes the $1 million mark in year 30, finishing at $1,043,000. Next up is John. He's in his 40s, earning more than he did in his 20s, and starting to think more seriously about retirement. He still wants his money to grow, but now there's also a focus on keeping it safe. That's where the balanced wealth compounder strategy comes in. John's portfolio is built with 40% in SCHD for consistent income, 30% in VT for global diversification, and 30% in QQQ to stay connected to growth and innovation. With that setup, the portfolio has a dividend yield of 2.17%, a 10-year dividend growth rate of 8.6%, and an expected share price appreciation of 10.83%. At this stage in life, John likely has a bit more saved, so we assume he's starting with $45,000 and contributing $20 a day, or about $7,300 a year. That might sound like a lot, but for someone in their 40s with a stable income, it's a realistic, meaningful way to build serious momentum. So what does that look like in real terms? The red line tracks John's dividend income, which starts at around $1,000 a year in year 1 and climbs to $4,000 by year 10, then reaches $13,000 by year 20. At the same time, the green line shows his portfolio balance growing from $58,000 in year 1 to $283,000 in year 10, and crossing the $1 million mark by year 20, ending at around $1,040,000. Last up is Jacek. He's in his 50s, maybe even early 60s, and retirement is starting to come into focus. At this stage, the priority shifts. It's less about chasing aggressive growth and more about protecting what you've built and generating steady income. That's where the capital preservation and income plan comes in. Jacek's portfolio leans into stability, with 50% in SCHD for dependable dividends, 30% in VT for global diversification, and a smaller 20% in QQQ to keep some exposure to growth without the full volatility. With this strategy, his portfolio delivers a 2.49% dividend yield, a 10-year dividend growth rate of 8.72%, and expected annual share price appreciation of 9.85%. We assume Jacek has a stronger financial base, so he starts with $270K already invested and continues contributing $25 a day, or about $9,125 per year. At this point in life, that level of contribution is realistic for someone who saved consistently or sold a business, downsized a home, or simply built up their retirement accounts over time. Let's look at the results. The red line tracks Jacek's dividend income. In year 1, it's already around $7,000 annually. By year 5, it grows to $11,000, and by year 10, it hits $20,000, providing meaningful income as he approaches or enters retirement. The green line shows his portfolio balance starting at $312,000, growing to $540,000 by year 5, and breaking the $1 million mark by year 10, finishing at $1,017,000. SCHD gives you a strong foundation, but if you want to reach your retirement of $1 million faster, you need to fill the gaps. Add global growth with VT. Add innovation with QQQ. Together, they fill the gaps and give you a smarter, faster path to $1 million future. Want to know how to turn a one-time $500 investment into a portfolio that pays over $5,000 in monthly dividend income? Click the video on screen to find out.